Allô, allô.
Hello, can you hear me?
Good afternoon, Makta. This is Marco Boin speaking. Just to inform you that Dr. Ngozi will be just 5 minutes late. Just 5 minutes, no more than 5 minutes. And I apologize
Okay.
for this delay.
No problem. Okay.
Hello, hello. Okay. I'm going to say all of this. Hello, everybody. Good afternoon. Hi, Makta. How are you?
Very well, Ngozi.
Sorry
How are
to
you?
keep you waiting, and
Not at all.
there's
Not
a
at
lot
all.
going
No
on
worries.
here. But I want to greet you and thank you for participating in this. We would have loved to see you in person, but we have Susan here, so we'll make do.
Absolutely.
So I also want to say hello to everyone who is participating in the room and online. I think this is a great occasion, certainly a favorite one of mine after looking through this report. So can't wait to get it started. So let me hand over to Susan.
Thank you. Thank you, everyone, for joining. We're going to start with just a very brief presentation of the findings of this report that we're launching today. I don't have to tell you that global trade is an engine of development and growth. So since 1990, global trade has grown by roughly 25%, but for the poorest 40% of countries, it's grown by 50%. Trade finance is the unsung reason for much of this trade growth and is quite essential. So globally, between 60 and 80% of global trade transactions are covered by trade finance. However, that is not equally distributed. The Asian Development Bank, previous slide, please, thank you. The Asian Development Bank has found that globally, they estimate that there's a $2.5 trillion trade finance gap. That is mainly in emerging and developing countries. So 2 years ago, the IFC and WTO embarked upon a relationship to understand this trade finance gap in more detail, to look at what's happening at banks and in firms to understand what's causing the trade finance gap and what we can do to ameliorate it. This is the second report that we're launching. Our previous report a year ago was launched a study in West Africa where we looked at Senegal, Cote d'Ivoire, Ghana, and Nigeria. So today we're very pleased to share with you and discuss the findings of this report, looking at the Mekong region, which is Vietnam, Cambodia, and Laos. So next slide. In a nutshell, we find, first of all, that these three countries have very high levels of trade integration. So over 200% for Cambodia, 185% for Vietnam, and over 100% for Laos. However, only a very small share of these trade transactions are covered by trade finance. Only 21% in our survey of banks in Vietnam and less than 3% in Cambodia and Laos. Moreover, the trade finance that exists is very expensive. We find that the all-in cost of a letter of credit is up to 5% and 12 to 14% for other types of trade finance. This is compared to less than 1% cost of the trade value in advanced economies. In addition, we find that when banks do offer trade finance, they offer really the traditional types of finance like letters of credit. Only 2% of trade finance in the region or these three countries is for supply chain finance. So using survey results as well as data and modeling, we estimate that if we could increase the coverage of trade finance in the region by 20 percentage points, so doubling it, it would increase the volume of trade by 5 to 9%, or nearly $55 billion a year worth of trade for Vietnam and $3.5 billion for Cambodia. So on the next slide, I don't have to tell you that the Mekong region has been a hub of global trade growth. So across the three countries, the volume of exports and imports grew from 200 billion annually 10 years ago to 800 billion today. That's and as a percent of GDP, it's well above the world average at roughly 3 times as much. Next slide, please. However, despite all the, next slide, please. So despite all the advances in trade, we find what we're calling two-speed trade growth. So first, when you look at the destination of exports and imports, it's very heavily centered around the US and around China. So trade with the US and China grew 5x over this decade. Trade also grew in absolute terms with Japan, the rest of Asia, Europe, and other regions of the world, but at a much slower pace. When we look at the results of a firm survey we did of 800 trading firms in Vietnam, we find that there are distinct patterns of how firms participate in trade. On one hand, there are larger firms that transact in global value chains, particularly in garments, textiles, and electronics. These firms are growing their trade much faster. Then there's a segment of smaller and medium-sized firms that are participating in local value chains, and trade there is growing, but not as fast. Next slide, please. When we look at the coverage of trade finance, as I mentioned in the opening, it's quite low. So Vietnam stands out. Roughly 20% of trade transactions are covered by trade finance. And it's less than 3% in Cambodia and Laos. But the trade finance that exists is quite expensive in global terms. So an all-in cost of letter of credit is 4% in Cambodia, 5% in Vietnam. That compares to 2% on average across other emerging economies and less than 1% in advanced countries. Next slide, please. Not only is trade finance limited and expensive, it is also unequally distributed. So our surveys indicate that large firms in the region are much more likely to get trade credit than small and medium-sized firms. Domestic companies are more likely to get trade finance than foreign-owned companies. And the companies in the lower tech manufacturing are more likely to get trade finance in high-tech manufacturing. Now, I will say that there's one caveat in our survey. So we surveyed the vast majority of banks in these three countries, and we conducted a survey of firms in Vietnam. But these surveys are covering domestically provided trade finance. So it's possible that some of the larger firms in this region could be getting supply chain finance from foreign buyers. And that would be captured only by conducting a global survey of banks in the originating countries like the US and Western Europe and Japan. Next slide, please. So at this point, I'm going to hand it over to my colleague, Marco Buon, who's going to talk about what we found about why trade finance provision is so low and what the impact would be of closing this gap.
Thank you, Susan. Asking the banks, what the banks are saying is that they are not providing more trade finance because of limited access to low-cost funding, which is a code word for high interest rates locally, high perception of the risk of their customers, which they cannot always appraise, partly, for example, because there is no proper bookkeeping by firms. There are also issues about finding collateral from their customers, which is an issue you find in many developing countries, because in trade finance, banks do not trust the merchandise as to be the natural collateral for lending. Then they ask for another collateral, which is typically cash collateral or land collateral, which landless and cashless companies do not have. So this is one issue that keeps coming back in our surveys. And finally, they do not have mastering or access to new trade finance product entering the market like supply chain finance. Next slide, please. So indeed, what we do find, and please look at the right-hand side panel here, what we do find in the kind of trade finance that is supplied by banks is essentially traditional trade finance. Vietnam, 45% on the right-hand side panel, 45% of trade finance that we counted for was export finance, so loans for exporters, and 55% was for importers, right? And basically all of that is sort of traditional loans or letters of credit. We find only 2% of that is to be supply chain finance. So the story is that most of trade in that area is already supply chain trade, but only 2% of that is supported by supply chain finance, which is the most efficient and cheapest form of trade finance. Next slide, please. When we what we call counterfactual calculation, which is what would the world be if there was more trade finance available at a cheaper cost. What we would find is an increase in exports of Vietnam and Cambodia by around 9% every year. So every single year, and an increase in imports of 5 to 6%. And in monetary terms, that's 55 billion in additional trade for Vietnam and 3.5 for Cambodia. Next slide, please. And would be gaining mostly in terms of the direction of trade? Well, that would be Asia. That would be intra-Asian trade. That would be most of it, 30 billion out of 58 billion. A bit North America, that would be more exports from Vietnam to North America, and more exports from Cambodia to Europe, as well as to the rest of Asia. And in terms of who would gain from these sectors, that would be essentially locally owned supply chains that are booming right now, and that would benefit most to local employment and GDP. And that is textiles and clothing, and that is processed foods, and it is electrical parts and machinery. Final slide, please. So what can we do about all of these? Well, there are things that could be done in terms of diversification of trade finance and strengthening the regulatory framework. The report goes into this. There are issues about building market awareness, promoting electronic platforms, promoting market infrastructure, like a market for invoice financing, and so on, broadening the customer base, educating SMEs as to what the products available are, what to ask, how to engage with providers of trade finance, and improving bank agility and management capacity, how they could master the trade cycle. This is something also that IFC is specialized about and works with the bank together every day. And we will be doing a dissemination trip, hopefully to deal with some of these issues. I just encourage you to read the document, and I would pass the floor on to the Director General now.
Well, thank you very much, Susan and Mark, for that presentation. And I want to thank the whole IFC and WTO teams that have been involved in producing this report. Makta and I are coming next, and we'll structure our discussion around 3 questions. First, why are our 2 agencies cooperating on trade finance? Second, what have we learned from the 2 reports? And 3, what can we do to start addressing the trade finance gaps, which I think is the most important question in a way. So, Makta, if it's okay with you, should I go first?
Yes, please, Ngozi, go ahead.
Yeah?
Yes, you go ahead.
Sorry, I didn't catch what he said.
He said, yes, go ahead.
Should I go ahead? Okay.
Yes.
You can go ahead. Okay. Let me start then and make some remarks. Our developing country members regularly identify the lack of trade finance as a major obstacle to participating in global trade. In 2023, as you heard, the Asian Development Bank estimated the global trade finance gap, mainly in developing countries, to be $2.5 trillion, a staggering amount. Micro, small, and medium-sized enterprises and women-owned businesses find it particularly difficult to access trade finance. According to the Asian Development Bank, 40% of trade finance requests from MISMEs and up to 70% from women-owned businesses are turned down. So many of them give up trying. Inadequate access to trade finance functions, in effect, as a prohibitive trade cost, holding back trade and closing off economic opportunities for people. The local specifics of trade finance gaps vary considerably. That's why in November 2021, the WTO and IFC decided to undertake deep dives into the trade finance markets of certain regions. The idea was to use country surveys and improved analytics to reach a better understanding of where the trade finance gaps were and how they came about. This in turn would help all stakeholders better direct finite resources to fill in these gaps. For us, this meant IFC financing or joint WTO-IFC capacity building for banks, exporters, and importers in low-income countries. Today's report on Cambodia, Laos, and Vietnam is the second in the series. Last year's deep dive looked at West Africa. Next year, we will turn to a subset of emerging markets in the Western Hemisphere. So what have we learned from these two reports? In the countries we studied, both in West Africa and the Mekong region, no more than 20%, 25% of trade is supported by trade finance, against 60 to 80% in advanced economies. In Russian markets, limited available trade finance goes to well-established companies first, if not only, and we saw that in the slides. IFC's firm surveys show clearly that larger companies make greater use of trade finance, SMEs much less. We calculate, as you heard Susan say, that raising the trade coverage from 25% to only 40%, the average across Africa, would increase trade flows by 8% on average each year. The main gains would be for local SMEs and second-tier local suppliers of international supply chains. More trade finance means not only more trade integration, but also more socioeconomic inclusion through trade. In the ECOWAS region, trade finance was heavily concentrated. Too few banks directing too little finance towards a small group of well-established traders. This contributed to freezing the existing product profile of traded goods. More trade finance at lower costs could help achieve a more diversified trade mix. The similarity in headline numbers for the two regions, I too was really struck by this, was perhaps surprising, since ECOWAS economies are relatively unintegrated into global supply chains, whilst the opposite is true for much of the Mekong region. Vietnam's trade to GDP ratio you saw was 185, Cambodia's 210, 3 times the global average. But the low trade finance coverage in the Mekong region reflects significant bottlenecks and market segmentation. For instance, in Vietnam, international firms producing within the country can get support from global banks abroad. Large first-tier local companies can obtain trade finance from local institutions at higher rates. We also heard how only 2% of Vietnam's trade finance is supply chain. Only a handful of banks in the region can provide them. And in Cambodia and Laos PDR, the situation is even more difficult. So given all of this, what should be done looking ahead? That's the third and last question. Trade transactions in low to middle income countries should continue to be supported by trade finance programs implemented by the IFC and other multilateral development banks. These programs support imports and exports of food, medicines, and other critical goods when international banks withdraw. They provide learning by doing experience to participate in developing economies, allowing them to eventually reach a point where the private sector can provide trade finance without support from the multilaterals. So in this way, they're immensely useful. We must increase our efforts to integrate local producers into global supply chains. Supply chain trade represents half of global trade and 2/3 of international trade for Cambodia and Vietnam. So we found that only 2% of available local trade finance was supply chain finance. And this means that lower tier local producers are under great financial pressure when they trade. So much of their working capital is tied up with financing trade that they're vulnerable to even the slightest shock to demand, to prices, or whatever comes along. And in this shock-prone world, that is really a significant hazard. Now, while there are significant opportunities for more countries to tap into supply chain finance, supply chain trade, this will be held back if supply chain finance continues to lag behind. So one of the greatest challenges for the re-globalization, which we promote here at the WTO, is this. It will be the lack of supply chain finance. So the ability to increase the capacity to do this, of new trade integrators to finance their own trade expansion. This will be very, very important. So if we want to re-globalize, we need to make sure that we do something about the availability of supply chain finance. So let me end by saying that we need to promote a more granular understanding of the ecosystem in the emerging markets and in low-income countries to better target our support. The IFC and WTO reports have identified specific gaps, but we need to continue to promote awareness, capacity building in the field. I think you hear from Susan and Mark that some of the stuff we've done with workshops and capacity building in developing countries have been enormously popular and the demand is huge. So we need to do more of this. Finally, I hope that the meeting we had in Marrakesh, where we brought together multilateral development banks along with other public development banks, will be a continuous affair that will enable us to put all our eggs together to see how we can fill this basket of the gap in trade finance. Thank you. Makta, over to you.
Thank you very much, Ngozi. It's such a pleasure to join you. I wish I were able to join you and be with you. First of all, I would like you really to thank Ngozi for a tremendous and wonderful leadership. This issue of trade finance, of improving the ability of private sector, particularly emerging economy, to have access to financing, it requires a lot of effort of everybody. So having a leader at WTO who can bring people together, who knows so well the ecosystem of the international finance architecture, is essential. And I would like to thank Ngozi for leadership in really pushing in this area. And if we look at a little bit what we done together in the last year, I'm quite proud of what Mark, Susan, and the team has been doing. We've been able actually to provide a lot of information to market participants on how we could improve trade financing. I will not repeat what I've been said about the importance of trade financing. It has been well documented. I just want to make a few points. It's interesting to have these studies which are regionally contrasting the reality of two regions. But while we have some differences, we have a lot of commonality. What we have seen is that cost matters. The small firms don't have access to trade finances as an acceptable cost. Secondly, is inequally distributed. And large companies which have access to capital market, which are well financially integrated, which are part of the global supply chain, have access to trade finance at a lower cost. The very essence of WTO, of IFC, is to fight poverty, to address inequality in this country, and to use trade as an instrument to reach that goal. So for us, this finding is important because it brings us back to the heart of what we are about, which is to support local production and to have better integration of low-income countries. What I've seen is Mark make a very important point on the regulatory framework. Working together will help us to move the needle. That's why in the discussions that Ngozi had with the World Bank, with IMF and other colleagues, an emphasis has been put on the regulatory framework. And jointly, we will be approaching also IMF and other institutions to see in the policy programs that have in countries, is this bottleneck which have been identified on the regulatory framework could be addressed through those programs and therefore contribute in making things happen. Secondly, there are a lot of externalities of pushing for more trade finance. As IFC, we have doubled now our trade financing, and we will be continuing doing that. But what we are starting to do more and more is to mobilize resources which are not from IFC. So we use our own capital to finance trade finance, but also we are now bringing more and more banks which are a capital market intervenant, which traditionally were not looking at trade financing, to jointly finance with us, the banks, and support the effort in trade financing. So we have more mobilization of capital market in supporting trade financing. Secondly, we are also working with a lot of companies in the real sector. One thing is to provide companies with trade financing. Another one is for them to help them meet the requirement that the international market has in terms of production, in terms of quality, in terms of alignment with COP21, with COP21 climate change requirement. All of these things need to be addressed. And often the small companies don't have the resources, the technical assistance, the equity to be able to do that. So by working also on trade financing, IFC is also able to reach a segment of the market that we were not reaching, and we'll be able to really help the bottom of the pyramid and have them more integrated. Third, another big important externalities of trade finance is that it helps you also to improve the infrastructure in countries. When you could look at trade, a lot of the logistics issues which are related to trade are often a bottleneck for countries. And even if you look at locally, I'm not talking about international trade or trade finance, but just all the e-commerce that you are seeing in a lot of emerging countries. One of the constraints is simple things like cadastre. If I want to do B2B trade, if I don't have a very clear address and a good geolocalization of my client, it's difficult to do business. So there is a whole array of issues that needs to be addressed to be able to have the bottom of the pyramid to be much more integrated. And that's why there's a very strong complementarity between IFC and WTO. The great powerful role that WTO can play in bringing people together to discuss all this in a very holistic manner, not to see it in separate pillars or silos, but to look at it in a very integrated manner is a must. And we have that opportunity today. What we are seeing already is that the first report that we have in West Africa has helped us a lot in bringing more people to finance, to increase trade finance. And we hope that this report also will allow us to address some of this and to attract more capital in financing trade in the world. Lastly, looking forward, I think that having continuing having more diversity geographically on country we'll be covering is an important point, because it will allow us to see the commonality between what is common between all these countries, so that we can design instruments that we can deploy across the world easily, but also to see the more specific constraints that each region is facing and to be able to address them with our specific product. So I think, Ngozi, I am very, very excited with what I've seen. And I'm extremely grateful to the team for the quality work that I've done on this. And there is no option than us working together like we did, and more importantly, to bring others to join us like we did in Marrakesh. We agree, you and I, that we will seize all opportunities that we have to bring more people to join us. And I've seen a lot of enthusiasm from other DFI. I'm talking actually tomorrow with one of our colleagues from France, who it would be very interesting in supporting us in this effort as well. So I will stop here and leave it to you and to the Q&A, and we're delighted to answer any questions that you might have. But once again, Ngozi, Mark, Susan, thank you very much for the excellent job that has been done. And I would have loved to join you physically, but unfortunately, I couldn't make it this time.
We have been clapping hands. That's why you have a strange noise in your ear.
Okay.
Okay, we will close the session of the DG now and come to the panel discussion with Ralph Ossa and his guest. Thank you so much, DG.
Thank you very much to all of you. Thank you. Bye.
Okay, well, thank you very much. This was an extremely interesting presentation. I had read the report, of course. I had read various versions of the report, but to see it, to see the final product and the excellent presentation was really very interesting. So, and now we come to the second part of the session, which is our panel discussion. And we're fortunate to have a very distinguished panel. I don't want to say too much, but I at least want to briefly introduce them. So we have Mr. Le Dinh Ba, who's the Minister Counselor and Deputy Permanent Representative of Vietnam to the WTO. We have Professor Kalina Manova from University College London and Professor Banu Demir from Oxford University. I've known these two for quite a while. We are meeting today. So I wanted to start by asking the panelists, maybe some general questions at the beginning, allow them to make, some of their, some of the broader points they would like to make. And then if we have time, we'll go into some discussion, perhaps also trying to relate this a little bit more to the report. But we didn't want to limit the discussion to the report, but really, talk about trade finance more broadly. So, Minister Counselor, maybe I can start with you. And, just ask you in broad terms why trade finance is important for international trade in your view, and also particularly perhaps how it matters for emerging markets.
Thank you very much, Ralph, for inviting us to join this distinguished panel. And thank you very much, the IFC and W team, for the wonderful work you've done. This is a very good question for me, and as a government official and trade official. Well, to respond to your question, the first thing I would like to say is that since our economies integration, regional and global 3 decades back, we've ever building the set of trade agreements, both at the regional level and at the global level. And we see it as a highway for trade. Mm-hmm. So since then, we've the mileage of the trade highways has ever been expanding. And what we care about as trade officials is rules, market access. Well, not only in traditional terms, market access for goods, for services, but also new rules for other new issues like environment, for labor, for government procurement, and so on and so forth. So we've been focusing on that solely. And what we overlook here, and the most important thing that we have overlooked from years to years, is that the trade finance. So we leave it to someone else to do the work. So what I can, my favorite metaphor is the trade highways. It's like the highways in Vietnam that I recently went back last summer to drive on the new highways that has been built. So the trade highways are well designed for cars, for vehicles of different plates, international, local, international for FDIs, local for MISMEs, for local merchandise, local companies. So they have different speed. International car plates supposed to be faster. Local vehicles supposed to be slower. But all of the vehicles have something in common, which is the oil, the wheel, to the engine, in order to avoid the pan, avoid breakdown, and noise. So again, my favorite metaphor is the highways in Vietnam that I've been driving recently. We build hundreds of kilometers of highways. But the thing that we forget, and I haven't seen the service stations, we don't have the service stations for certain part of the highways that we already beautifully built. So that's the things that I'd like to mention here, is that the importance of trade finance for our trade highways. And that's where the noise come from. And the noise from highways to our public forum, which is widely debated recently in Vietnam, whether the FDI should take the bigger piece of cake and the local companies have a smaller and smaller piece of cake. And that's the noise coming from the highways to the public forum, even the National Assembly and other forums that has been discussed recently. How to reduce the inequality, and how to provide a greater access for SMEs, for women-led enterprises, in order for them to have a better access to the trade finance in general and supply chain finance in particular. So I think that's already answered part of the questions. But I think the full answer that can be found in the report, and I think the message is really powerful. It's going to be sent across governments, that there's a huge room for improvement for governments, especially in emerging markets, that the things that have to be done in order to reduce the inequality, they provide a better access for local enterprises, for local merchandise and companies and suppliers at the lower tier in the supply chain, to basically close the loop of FDIs and local suppliers. So that's I think the essential question for governments, and that's where the development issues come from, that can be explored further. Of course, from the government point of view and from the regulatory point of view, we think that there's should be a lot of things that can be done. And of course, I'd like to take this opportunity to show my appreciation to the work done between IFC and our local government agency with respect to capacity building, with respect to improving the capacity and the operation of the agency, like the National Registration Agency for Secure Transactions, that the things that have been quite successfully carried out with a lot of projects in cooperation in recent years. But with respect to secure transaction, for example, there should be many other things that can be done. For example, we've been talking about the cross-referencing between the National Registration Agency for secure transactions for movables assets, as opposed to the local land registration agency for immovable asset as collateral in support trade finance. So those are also the areas of improvement, but I'm gonna stop here for the moment. Thank you.
Well, thank you very much. That's fascinating. I love that metaphor of the trade highway. I think we're gonna adopt this also. I can already see lots of things, lots of uses for it. But maybe let's turn it over to the academics, and maybe I can ask you both the same question, and you can just give me your perspective on it. Basically, giving us perhaps an overview or your take on the research that looks into the relationship between trade finance and international trade. Kalina, maybe you start here.
Thank you very much, Laura. It's a real pleasure to be here. And I thought the report was fascinating in documenting facts and uncovering where the trade finance gaps are in some ways to move forward. The academic literature has made quite a bit of progress on these issues in the last 15 to 20 years. And by now, we have overwhelming body of evidence that access to finance is absolutely first order for successful international trade participation. Financial frictions have a major impact on deterring trade activity at the firm level, which also manifests in aggregate distortions. And financial conditions also have important effects on the pattern of multinational activity worldwide. So what I would do is organize this overview of the literature around 3 points. I'd first like to discuss why financial frictions for access to finance matters and what are some sectors that are particularly sensitive to access to finance. Secondly, what financial conditions enable financing trade activity. And finally, what is the evidence about the dimensions along which trade participation and FDI are shaped by financial frictions? So first, why does finance matter for trade? Of course, all firms require access to financing to cover working capital needs as well as long-term investments. But exporters are disproportionately sensitive to access to finance for 3 reasons. They need to fund additional sunk costs and fixed costs associated with forming new partnerships with buyers and suppliers abroad. They might need to customize products, establish and maintain foreign distribution networks, and of course, the actual shipping and other trade costs. The second reason is that even if all goes well, the processing times for cross-border transactions are on average 20 to 60 days longer. And so even if, everything is well, you do need to manage your liquidity that much longer. And the final reason, which has received less attention in the literature to date, is risk. Transaction risk is inherently higher for international transactions, partly because of country risk when you're transacting with emerging markets, partly because whenever you contract across borders, you have to handle the contractual risk of, should anything go wrong, what jurisdiction do you turn to? So these issues are known to be much more significant in some sectors than others. And this is inherently related to sort of the technological features of, doing stuff in a given industry. One dimension is how much external finance you need for your long-term investments. So you can think about capital expenditures, how much of that can you finance out of cash flows from operations. Another dimension is short-term liquidity needs. People often look at do you need to hold on to inventories either on the input side or output products? And how important is that relative to your total sales revenues? This has to do with, if you need to produce a car, you want to be able to meet demand. So you do need to stock some wheels and so on in the background. So basically, some sectors require a lot more access to external finance, either because of these long-term investment needs or because of the intense short-term liquidity demands. Which sectors can get access to that finance? Collateral matters. We heard this in the report as well. So sectors that are characterized by more tangible assets in the form of plant property and equipment are going to always have an easier time getting the money they need. And finally, this is something that Bano, I think, will discuss more. Outside of this bank financing, of course, there is opportunities for firm-to-firm buyer-supplier trade credit. In principle, you might say, the kind of firms that are trustworthy enough to transact with banks might be also the ones that are trustworthy enough to get financing from their partners. So in that sense, trade credit and bank financing might be complements. In practice, in the data, it does seem like they're substitutes. So to some extent, sectors that more typically extend trade credit to each other are a bit more protected from bank financing. Within each sector, there's also a lot of evidence that smaller, less productive firms have a tougher time accessing finance. And the presumption is that they not only have less collateral, but also they have a smaller profit stream that they can lend and borrow against. Okay, so much for, why finance matters and how those needs vary across sectors. What are the financial conditions that facilitate trade? And here, I would say the literature has thought about deep, slow-moving institutions, somewhat more kind of faster-moving outcomes of, how much finance is actually available in debt and equity markets, and then high-frequency movements in the cost of capital. And suffice it to say, all 3 matter to a first-order extent. So long-term, if you look across countries that have stronger contract enforcement and rule of law, strong creditor rights protection are the ones that will have a comparative advantage in those sectors that require a lot of access to finance. So that matters. Those institutions are hard to change. When you look at actual market outcomes, of course, there's debt and equity. There's been more work on debt, usually proxied by private credit relative to GDP. So the total financing available to the private sector by banks and other financial institutions scaled by GDP. It does move within countries over time, and both cross-sectionally and over time, you see that countries with better developed banking systems are going to outperform in trade terms. Turning to the stock market, there's been less evidence, but it does go in the same direction. When you think about high frequency movements in the cost of capital, do they have a bite? The answer is yes, especially during crisis episodes. So there's been some compelling evidence that at the peak of the global financial crisis, 2007-8, movements in the interbank interest rates were very highly predictive of what was happening to trade patterns. And again, the effects were disproportionately worsened in those sectors that are particularly sensitive to access to capital. Even outside of those crisis episodes, people have looked at bank to firm linkages and essentially try to identify shocks to banks' assets and see to what extent that ends up disrupting the activities of firms that tend to transact with those banks. Remarkably, you do see effects which suggest that at least short-term firms cannot easily pivot and find alternative sources of bank financing at least. There's been less evidence on the equity front, but some preliminary work suggests that IPOs matter as well, which might puzzle you. Firms that tend to reach this stage of, joining the stock market, you might think is not being very financially sensitive, but even there you see big effects. And finally, a lot of what I've discussed has to do with sort of the domestic financial system, institutions or market outcomes. What about the role of foreign capital flows? There's evidence to suggest that foreign capital flows can, to some degree, compensate for weaknesses in the local financial environment. I think evidence from liberalizing stock markets is quite telling. So opening up the domestic equity market to foreign investments, essentially portfolio investments, seems to improve trade activity systematically. And the impact is greater on countries that start out with less active stock markets, less developed banking sectors. I will come back to talking about multinationals because that's another source of financing as well. So let me then turn finally to, what are the dimensions along with poor access to finance can disrupt trade activity? Compounding evidence that their distortions are sort of at different levels. At the firm level, you're seeing less entry into exporting. Conditional on exporting, you might be entering fewer markets, transacting with fewer partners abroad, offering a narrower product portfolio. Why does that matter? In the aggregate, we know that more diversified trade partners is correlated with steadier export growth and less volatile export growth. In addition to these distortions on sort of, you might say, the extensive margin of market entry, you also see big effects on the intensive margin. So even conditional on having those relationships, firms with more access to finance are able to transact at higher volumes. And if you are thinking of a breakdown of, these different margins, the effects on trade, the effects of limited financial development on trade go far beyond the overall effects on just the aggregate economy. This is not a scaling up and down of just general production activity. So estimates suggest that 80% of the overall disruption to trade is actually trade specific, nothing to do with just scaling up of GDP. And of those 80%, about a third is this extensive margin of fewer market entry, and 2/3 are diminished firm level trade activities. Effects were much stronger in the financially sensitive sectors and much worsened during the financial crisis. So for example, at the time, if interest rates had never gone up to those extreme levels, trade flows would have been 30% higher. If they had, if countries had not intervened and the interest rate had remained at the very scary levels throughout the whole crisis episode, trade would have been 30% lower. So really big effects even of short-term movements, perhaps global rather than local movements in the cost of capital. Turning to the effects of financial frictions on multinational activity. Generally, multinationals are in a position to arbitrage cross-country differences in the cost of capital, but not fully. So evidence from the finance literature, quite apart from the trade literature, indicates that whenever they can, foreign affiliates borrow locally. If that doesn't work, then they get additional injections, both debt and equity from the parent company. There's also evidence that, the decision whether or not you vertically integrate a foreign supplier is actually in response to local financial conditions. If the local economy does not support those operations, you're actually more likely to vertically integrate as opposed to just outsource at arm's length to an independent party. So that suggests that, if local financial conditions improved, yes, domestic firms are going to benefit more than the foreign multinationals, but foreign multinationals will also engage more with that economy. In the data, we see that they're more likely to enter and they're going to increase the scale of operations, but they will also reorient the nature of their activities. They're less likely to sell locally in the local market, presumably because they're facing this healthy competition by domestic firms, but they will produce there for foreign markets, so sort of using it as an export platform. So I hope this provides an overview of the main results coming out of this literature. So financial frictions matter because firms require external capital to operate, especially to trade. Various dimensions of financial institutions and actual market outcomes have a first order role. And the impact is there when you look at trade, MNCs, and GVC activity. We're going to come back, I think, to GVCs later, so I was brief there. But just so I don't forget, if you think about processing trade versus ordinary trade, you do see effects there as well. When you're conducting processing trade, you're not designing the product. You're also not responsible for foreign marketing and distribution. So your working capital needs are much smaller. And we do see that in economies with tight financial conditions, firms are disproportionately likely to sort into processing trade rather than ordinary. Does that matter? Yes, because those activities correspond to narrow segments of the value chain that are less profitable. So I'll stop here by saying that where I think this goes next is thinking about closing the trade finance gap, but importantly also providing insurance for transactions that are either inherently risky or perceived to be risky. So there's been less academic literature on this, partly because of data availability. New data from the Berne Union of Export Credit Agencies suggests that there's some very strong systematic patterns. Countries with higher risks require a lot more, or exports to countries that are riskier require a lot more insurance to secure bank financing. And private insurers are willing to capture some of that, but beyond certain risk levels, it really is up to export credit agencies to step in. Thank you.
Thank you very much. It's my first time at WTO. So thanks for the invitation. So it's great to sit this panel, and it was also a pleasure to be one of the peer reviewers of the report. So what I'll try to do is not to repeat what Karina already said. So she gave an amazing overview of the academic literature. I'll focus more on the smaller literature on direct instruments of trade finance, like letters of credit. So unfortunately, if you look at the amount of work, academic work, focusing on letters of credit or more direct instruments of trade financing, it falls short of their importance in practice. And the main reason for that is not because academics are not interested in looking at these questions, it's mainly because of lack of data. So there are only two potential sources of data for this type of analysis. So one is customs records, but only a few countries actually require firms, importers and exporters, to report the payment method or financing term on the customs declarations. Turkey, Chile, Korea are a few of these countries. The second source of potential source of information or data is banks. So banks actually know their exposure through letters of credit. So it's a matter of a centralized initiative that will convince banks to report this type of information together with other types of data they are reporting to BIS and other institutions. But regardless of the source, unfortunately, we won't be able to know the trade finance gap because these administrative data sources will tell us an equilibrium outcome. So what is the amount of letter of credit? So it's not going to tell us how much firms actually requested versus how much banks were able to provide. So for that, the surveys, extensive and well-designed surveys like the one conducted by WTO and IFC are quite valuable. So I hope this will be replicated in other regions and will turn into something like BEEPS, Business Enterprise Survey, so everyone will be able to keep track of what's happening to trade finance gap within countries and regions and also over time. So based on the available evidence from customs data or SWIFT data, there's a couple of empirical patterns that turn out to be quite robust in terms of the usage of letters of credit. So first of all, the estimates of the fraction of trade that is financed by letters of credit ranges between 10% and 15%. So you might think it's pretty small, but there's quite a lot of heterogeneity when it comes to industries. So for instance, in metals industry, it goes up to 70% in some countries. And here you start sensing a chicken and egg story. Why? Because so most of these firms operating in these industries, not only metals, but more industries where products are more homogeneous. So they're big. So scales are big. So these firms are probably more likely to pay the fixed cost of letters of credit or already have good access to bank financing and other types of formal bank instruments. So they are able to get the letter of credit. And at the same time, from bank's point of view, so these products are collateralizable, right? So the risks are lower. So banks might also be more willing to extend letter of credit in these industries. So this is the first chicken and egg story. There are others. So if you look at the detailed customs data, you see that larger firms, not only larger firms, but larger transactions are also more likely to be financed by letter of credit. So this is this can be explained by the risk factor, right? So if the transaction size is big, then of course risks are bigger. So you would need trade financing to cover the risks or shift the risk onto banks. But at the same time, if these transactions are done by larger firms, you still have the collateral part, right? So these firms have the collateral, so they're more able to get access to trade finance and everything. And the third one is so new relationships are more likely to use letters of credit, because if there's a new importer-exporter relationship, then the trust relationship between these trade partners is yet to be established. So both sides want to protect themselves from risks, so they are more likely to use letters of credit. Then letters of credit become costly. So instead, one of them just can finance the transaction either through cash in advance or open account. But this is important from developing countries' point of view. Why? Because on the one hand, we are telling these countries, you know, you have to move to more higher value-added products, so you need to enter new markets, you need to do product innovation, but all of these require establishing new relationships, right? So they will produce new products, so they will probably have to sell it to a new buyer. They will have to enter a new market, and for all of these, since they are unknown in that product or to that particular firm, they will need letter of credit. So they have to finance innovation, and at the same time, they have to finance the transaction. So it's asking a little too much from these firms. So in general, we don't have much. It is a very difficult task to understand the demand and supply factors. So which factors are important. So in real life, probably both factors matter a lot. But for policy making, we need to know the relative importance of demand and supply factors. So this is something that we won't be able to probably get from the administrative data. So these surveys will be very important. So one final thing I want to say is, so crisis. So we had one crisis, 2008 financial crisis, and then more recently we had the COVID crisis. So both are crises and both had quite important economic consequences. But from trade finance and risk point of view, these are very, very different crises. So if you look at what happened to, for instance, trade transactions happening on letter of credit terms during the 2008 financial crisis, you see that they were affected more negatively compared to others because that was a banking crisis. So the main shock was on the supply side, not on the demand side. But if you look at what happened to transactions that are potentially that potentially use more letters of credit during the COVID times, then you see the opposite result. I mean, probably everyone will agree that it wasn't a banking crisis, so not much was happening on the banking side, but risk of doing business increased for everyone. So when you look at the data, you see that those transactions that potentially use more letter of credit showed greater resilience during the COVID crisis. So that already tells you the importance of demand and supply factors, but quite broadly. So we definitely need more data, more detailed data to be able to understand which one is more important. Thank you.
Well, thank you very much, Kalina and Banu, for this, I thought, extremely interesting and insightful overview of the research. And of course, I should have said this at the beginning. You know, they're both have made major contributions to that literature, so it's no coincidence that you know it so well. So I wanted to. I mean, I've been learning a lot already now from the report, from the academics, from the policymakers, but there's you know, two concepts that I hear about a lot in that space, also in the report today to some extent. And one of them is supply chain finance. So that keeps coming up, how important that is and how small the share of supply chain finance is, and that this is really the way to go, and so on. And then what I also hear a lot, maybe not so much in this report, but even though I think we touch on it too, but I've heard other panel discussions on it, is this idea of green trade finance. So I just wanted to ask you all if you have any thoughts on these, what seems to me as an outsider be some of the hot topics in the trade finance space. I don't know, anyone?
So let me start from the environment part. So these new regulations, I'm afraid, are putting even more burden on small and medium-sized enterprises. So these firms already have limited access to formal forms of financing. It's not only letter of credit, but any type of financing. And now we are asking these firms to do reporting and then monitoring and then doing investment to be able to access certain types of cheaper financing. So it's a little contradictory because these firms were already having difficulty in accessing formal forms of financing, and I'm scared that these firms will be cut even more severely from this type of financing. But here, I think supply chain solutions become important. So maybe the policymaker is presenting these firms with some new regulations that are costly. And I think when it comes to climate change, so we are always presenting these firms with difficulty. Okay, so this is the cost. You need to do this. You need to do this. But what is missing there is, so what is the benefit? So there are also some opportunities here, right? So these type of regulations do not have to be only costly, right? So maybe some of them are actually profitable. Maybe by doing so, firm will be able to expand its business network, do some innovation, increase productivity. So it will be good for the firm as well. Unfortunately, the current language is not putting enough, I think, emphasis on the opportunities or profit side, but just focusing on costs. But supply chain financing, as I said, might be a good solution, a cheap solution, because so regulation is there, but we know that between buyer and supplier, things might work quite efficiently. So if the buyer asks, if the buyer helps, then the supplier may follow, may be more encouraged to do things, particularly if there's an incentive. And this incentive could actually come in terms of supply chain finance, right? So the firm say, okay, so do this, and then you will be able to get supply chain financing even better terms. And there, I think, so this is a chain, so the supplier, buyer, and there are multi-development banks, right? So who can put some money into this type of business, and banks will be happy, development banks will be happy, suppliers, buyers will be happy, and globally, everyone will be happy because it's also, I think, working towards achieving climate change goals. That's how I can combine the two questions.
Maybe just quickly, I also don't want to restrict you to this question. If you want to react to something the other panelists say, please feel free, of course.
Okay, thank you. I just pick up from what Banu just said about the supply chain finance and on the way to the green financing. Of course, trade finance is already a big issue for SMEs. And when it comes to trade financing, when it comes to green financing, green trade is also another burden, another challenge for SMEs, because it involves technology, it involves finance, it involves retraining of the manpower and everything. So I think that the government should be creative on these issues. Of course, the government is always risk-averse, then what we want is secure, right? But we should be innovative in this regard. And I think that technology, maybe fintech or other solutions might be the way forward for assisting the SMEs to basically gradually adapt to the new circumstances and survive and thrive in the new environment. That's the things that I would like to add. Thank you.
Let me jump in as well. So I think one of the reasons why I think supply chain finance is of such great focus these days is because we hear a lot about increasing risks along the supply chain and trying to understand what are the efficiency diversification trade-offs that firms face and how they resolve them. Another reason is because we're concerned about the developing process in emerging economies. I have moved away from the belief that certain segments of the value chain are inherently limited in terms of their growth potential. Humans are very creative. We continuously see technological booms in areas that we wouldn't have foreseen 20, 30 years ago. But I think it's fair to say that the evidence suggests that if you join a supply chain over time, as you gain in experience and scale, you're able to expand along the supply chain and become more profitable. So to the extent that finance is required even to start operations, let alone expand, that's another reason to think about it. There is a major data challenge in studying these questions. So I referenced some of this prior work on processing trade. It has actually been done in the context of China. It's one of these unusual contexts in which the customs records indicate how each transaction is conducted, similar to these payment terms, for example, in the Turkish data. In China, if it is under an ordinary trade arrangement or processing trade. Actually, within processing trade, they even make this further distinction between pure assembly, which is when the foreign buyer sends the inputs for free, both to ensure quality control, but also to essentially to reduce the liquidity needs of the local producer to just salary. And then there's processing with imports, where the domestic firm is supposed to produce according to the blueprints, the specifications of the foreign buyer, but is responsible for sourcing their inputs and paying for them. And so there is evidence that access to finance at the firm level or the financial conditions of the region where the firm is based matter for selecting into these different forms of trade participation. But within firms over time, you do see progression from one to the other, more profitable activity as finance access improves. In the context of supply chains, I mentioned data is limited also because conceptually we usually only observe one transaction at a time. We can't splice together the multiple steps of the supply chain. But I think that's where probably a lot of the finance gaps are. And part of the concern, I think, is that if there is a financial bottleneck at one point, it's going to actually potentially amplify downstream and essentially limit other activity downstream from taking place. Another concern in the context of supply chains, if you think about COVID, is, all of a sudden we remember that what matters for shocks is not just your first tier suppliers, but also your further suppliers. And, in electronics and other sectors, the bottlenecks were not the first tiers, they were sort of the higher up tiers. So when you think about financial frictions, it becomes apparent that it also matters who it hits in these complex production networks. If it ends up hitting someone who's very critical, sort of like a bottleneck in the supply network, then presumably the repercussions are going to be felt more widely. So this is, I think, reasons why supply chain finance is important to study, and we really need all the data we can gather. On green stuff, just to complement without repeating, I was thinking about what firms can do to minimize their carbon footprint. If you think about the classic, big polluting factory, of course, there are some carbon capture or filtering of methane gases technologies. They're expensive. They're big projects. They need money, they need time, and they need training. And I've noticed that in the work that I've been doing with data on export credit agencies is that a lot of the minimum financing and finance insurance that they're providing is for these long-term projects. So the classic example is, a windmill, which is going to be this massive costly transaction, and it's going to require backing trade finance insurance essentially. So I think that's where it also relates to greening production. This requires investments.
Well, thank you. We're already running out of time. I don't know how that happens, but it's like such an interesting conversation. But I thought maybe that's also a good thing because it forces us to be concise in the last few minutes. Because one question I would like to finish with is one that came up repeatedly in the discussion, and I think you've also answered it in various ways. But I also want to pose it directly, and that's the question of what. So one of the main lessons, I think, from the report, notwithstanding all the data issues that we are facing, is that there is a large trade finance gap. I think the series of reports have documented this, and it seems to be that there's some market failure underlying this. So of course we all want to know what policymakers can do to bridge that trade finance gap, and also specifically from the WTO perspective and presumably also the IFC perspective, what is the role of international cooperation in that? So if you could just briefly give us your sense, your view on what policy needs to do to bridge the trade finance gap, and what's the role of international cooperation, I would appreciate that.
Just very briefly, I think the most important thing and the most important message here is that we have to raise the awareness across the governments. And I think the report itself is a very powerful message to be sent across the governments. There's a gap, there's a huge opportunity, and there's a lot of things that the regulators can do and should do to assist businesses and firms to compete, to survive and to thrive. And I think that's the first thing that comes into mind for me.
I would say double down on trade promotion, trade facilitation, as well as ensuring stable institutions. Why? Short of providing outright trade finance, what is the underlying market friction that requires policy intervention? Presumably imperfect contracting, asymmetric information, concerns about risk and volatility. So try to remove those and the market will follow. So to the extent there's lack of information or knowledge about different things, trade promotion, trade facilitation is going to make a big difference. To the extent that stable trade policy, stable environmental stance, is going to encourage investments. We know that stability matters for sunk cost investments that are going to reap benefits over the long horizon. So I think those are the levers that I would pull, short of direct outright trade finance.
So the trade finance gap is a number, but what matters is, I think, where it is coming from. So is it too much demand or too little supply? So if you look at default rates, when it comes to trade transactions, it's pretty small. So if it's too little supply, it's because banks think it's too risky. It doesn't make any sense because default rates are pretty low. So there is something else here. And it is probably, so what we know as default rates is an average, but for some transactions, these default rates are potentially high, and banks are maybe better able to identify those, and they don't want to extend letter of credit or other forms of trade financing in those areas. But it is actually where trade financing is needed. So let's think about this infeasible policy where the government knows the exact amount of trade finance gap and gives it to banks lump sum. It's still not gonna close the trade finance gap because it's still up to the banks how to distribute that money. So I think here what matters is to understand really who really needs it and what needs to be done to reduce risks and distribute the financing in the right way.
Well, thank you very much for the answers to this question, but also thank you very much for this really interesting panel, I thought. So let me close the event also again by congratulating the lead authors of the report, not just for the latest iteration, but I think for this whole stream of work that's extremely important, I think, for our institutions, and I think, as we saw, to the broader policy world. So thank you very much all for coming.